Hi, this is part three of a six-part series of videos on great. Now you have $100,000 to invest. And in this videos, we examined some useful models to invest your portfolio. In the previous videos, we talked about how to use financial analysis to set up a portfolio and how really difficult it is for the average investor to do a complete job. This one is more practical approach and is sector surfer, what we are going to talk about now. And then in the following videos, we're going to talk about using moving averages, dual momentum, and a macro strategy. Sector surfer provides very useful models for beginners and sophisticated investors. This is this is the home page of Sector Surfer. By the way, I'm not sponsoring absolutely this website, but is a useful website for beginners and sophisticated also investors. Sector Survey offers good portfolios models, which I'll discuss later. Great help in understanding how the website works and how you select various models for various degrees of sophistication. And this is an important thing. It could be very simple, but could be highly sophisticated. And my suggestion is, if you decide to explore this website, and by the way, this is not the only one. There are many others available similar to this. Is to start simple. Let me make some important points about Sector Server, which I discovered myself by using it. First of all, it has many models and strategies that you can use. Many. Where is helpful is if you follow their recommendations and models, is that helps you managing risk, which means avoiding big losses, is the main reason for using their models. However, make sure, and I will provide a couple of examples, make sure that you understand their performance page. It is helpful, but you have to understand it very well, the meaning. Watch for data mining. Since this is an open website, you can set up your own portfolio and show that your portfolio is performing better than others. However, it could very well be that some portfolios are set up using the best performing of, let's say, ETFs in the past. So it shows the performance of the portfolio as of today, by using data in the past. Will the performance of the portfolio do the same thing in the future? This is called data mining. In other words, people data mine ETFs to show that their portfolio is doing very well. So be careful with that. Some models, what you will see is that some models perform like the market for many years. Only when you look, let's say, over 20 years, you show superb performance. So what you have to make sure that you understand that you're not going to invest in these models and make a lot of money tomorrow or the day after or a year or 2 years. These are models that long-term models. You have to stay there for the long term. So the way they do it essentially is, besides the timing, trying to stay away from the big losses, that they select, and this is what their really great logic and great programming comes in. They select the asset classes that are strongest at the moment, so that in an up market you will outperform the market using these asset classes. Therefore, you have the two winners. One, you don't lose money, and the other one, you stay with the strongest investment that you selected. The way I would suggest that you start, like I did, is to become familiar with their models using they have free strategy. I will show you what they are because I follow them. And they are very useful to understand how they're going to help you. They have, Sector Surfer has three main free strategies or models, if you wish. One using mutual funds, one using ETFs, and the other one asset classes. By using these free strategies, they will help you to become familiar with the performance page and also how they provide you with the timing signals and how they tell you what to do and what to sell and what to buy. These are the free strategies that I follow. One is the ETF Treasury bonds. So this is the name of the strategy. They give you various how the score, the safety, and so on. And this is the ETFs, the bond ETF uh, they are using in their portfolio. Here is what you should sell, and this is what you should buy, and this is as of the latest, the last signals that they provided. This is BlackRock asset classes, and these are the three mutual funds reflecting the asset classes. This is other Columbia asset classes. These are Dreyfus. These are all mutual funds, of course. These are ETFs. This is T. Rowe Price and these American funds. I think the ETFs is obviously a very important portfolio I use because so you see they can give you an idea what are the strongest and weakest ETF that they like. And the same thing is the bond market. If in case you want to use both strategy to minimize risk. By the way, they also sell this portfolio of strategies where you can use the strategy, let's say this one, and they tell you to use one rather than the other. So they also can time the strategies, not only the investments within a strategy. So I follow these because they tell me, buy BLV bonds, buy this mutual fund. So they give you an idea of what sectors and what asset classes their system likes. This is one of the free strategies and is the bond strategy. And as you can see, these are all the ETFs investing in bonds. And this green bar tells you which one they prefer. This is, again, I don't want to be exhaustive presentation on Sector Surfer. If you go to their website, you find all the explanations about what this data mean. The important thing here is this page also that says the chance of losing more than 15% in case of bonds is very low. This is the performance page over the performance page for the bond model. And as you can see, this goes from 2008, avoided the decline here because the bond market, by the way, was strong. And the bond portfolio had this performance, while instead the market, which was the white line, is this one. So the bond market widely outperformed since 2008 the stock market using their timing mechanism. As you can see, the main reason for their performance, of course, is that they didn't lose all the money in the 2009 market crash, and they always kept in the strongest bond ETF. So this is one model that, this is over 20 years, has done fairly well. But again, by the way, this is also a period where yields decline quite sharply, so that goes to the advantage of their performance. So what is the main point here of what I just talked about is, first of all, the model shows you that you really lack of volatility. I avoided the big decline of 2008 and 2009. The trend, however, of bond prices was up during those years, but still it was good performance. So this is the bond portfolio. If you want a low risk portfolio, this could be a way to go. However, what happens to the portfolio when interest rates go up for a long time? Well, this is not part of the back test. So this is the unknown known. The free portfolios uses asset classes in terms of ETFs, value, growth, small cap, mid cap, large cap, and international. This portfolio or strategy, as they call it, is about all the asset classes, the main asset classes. So, for instance, you have growth, you have mid cap, 500 ETF, 500 top 50 ETF, mid cap growth, Russell 2000, Russell top 200. So you have all the until you have the last one is international. So they have all the main asset classes. These are the usual ratios to understand the risk of the portfolio. This is what the probability of having at least a 15% chances of 15% loss. So it's higher than obviously than the bonds we looked before. Now this is the 10-year performance. This is important. This shows that the 10-year performance of this portfolio really is performed just about like the market for the last 10 years. So that's why I said the timing, it could be sometimes is good and sometimes is bad. That's why, data mining is an important issue here. But this did not perform well over the last 10 years. Now, what happens next? This is the same portfolio instead the performance over 20 years. Same asset classes. Look how well this has outperformed. So why did this is important? Why when you use their models, you understand why the performance is so unique. Really, this performance is unique not only because they selected the best asset classes, but above all, they didn't go through the decline here and here of the market. So their timing was such that they kept the portfolio in cash out of the market. And this what is probably a good reason why this superb performance. But having said that, this is a good contribution in case to the average investor, in case he or she needs a conservative way of investing and trying to protect the portfolio from unusual losses. What is the main point of what I talked about? Well, make sure you understand the model. Make sure what is that makes the model that you're looking at a good model. Is the bond? Is the volatility? Is risk management the main issue? Do you use the model to make sure you don't lose money, or you are protecting your money? Use the model to manage the volatility of your portfolio. Then you have to select certain asset classes instead of others. Over what periods of time the performance is computed? Check the backtesting. The backtesting allows you, the sector surfer allows you to select over 3 months, 5 months, a year, 2 years, 10 years, 20 years, and see how the performance has changed during that period and why makes it the model is superior. Or you have to wait 10 years before you start outperforming the market. But even then, maybe the model is good because that you don't lose money during a market crash. And then one thing, does the model fit your objectives and personality? So one way to solve that issue is to allocate some of the money to this model. So take a bucket of money and devote a small part to a model from Sector Surfer and see how it performs, and this is a good idea for you. This information is analyzed in detail in each issue of the Peter Duck portfolios, and of course is discussed in great detail in my 3 books, Profiting in Bull or Bear Market, Easy Ways to Beat the Market with ETFs, and Investing Wisely. It is easier than you think. Again, thank you very much for listening, and I'll see you really soon.